gold and silver, I think, are going to do, and just any precious metal will do very well because people are going to start to worry about the bond market. They're going to start to worry about currencies.
Hello, everybody. Welcome back to the next big rush. I am Fabi, and this is Andy from Finding Value Finance. He is probably one of the most popular guests that we have on. Whenever I host Andy, people are commenting, they're engaging, they're sharing. And so, obviously, for my own benefit and for the benefit of you, the viewer, I'm bringing back the one and only Andy. Welcome.
Thank you for having me on. Appreciate it.
No problem. And listen, let's just jump straight in. We're shooting this on the 2nd of April of 2024, and gold is finally making its move. It's broken an all-time high, and it seems to be holding on quite well. It seems to me, shockingly enough, that silver is finally finally actually responding to this move. At first it didn't. And I just want to get a feel for, where do you think we are in this bull market? Is this a move just to kind of confirm a longer term bull market, and maybe we're closer to a blow off top, or do you think we have tons of room to go yet?
So we've got an inverted yield curve. I'm specifically talking about the 2 and 10s. When that inverts, generally you get an inflationary impulse move. It inverts. Gold doesn't like when yields go up, but we're inverted. We've been inverted for, I think, 18 months, which is one of the longest yield curve inversions, I think, ever. And gold likes it when yields go sideways or lower. And I don't think the market, I don't think Powell's going to raise rates. I mean, he obviously could, but gold, where it's located, basically breaking into new highs with the yield curve and where that's located, the 2 and 10s being inverted. That's just a bunch of information that's basically stacking up in our favor, a confluence of events stacking in our favor for gold to perform well with good upside potential and low downside risk. And with the mining companies, and I'll kind of just jump around between both, the mining companies are also really, really low in relationship to gold. So I think that we're at the beginning of the beginnings of this bull market. And I think there's a lot of runway ahead of us from shorter term cycles and longer term cycles kind of overlapping on each other. The short term is that 2 and 10 business cycle. The longer term is this debt credit problem that we've got behind it. And some things to notice is we are making new highs in gold alongside with yields going up. And that's very similar to the 70s. And I've said that before, that I think this bull market that's coming is going to be similar to the 70s, not like the 2000 to 2011 bull market. So I think we've got a boatload of upside potential. If you price gold against other assets, whether it be Dow Jones Industrial Average, M2 money supply, total bank credit, all of those things indicate that gold could go way up for a long period of time, to levels that are probably, you guys would probably call me crazy if I were to actually calculate it out the same way as the 1980, the end of the 1980 bull market there. So I think we're at the beginning of the beginnings. I think we have a long way to go. And I think our government is basically the cause of a lot of these problems. And we've got full alignment with all these cycles lining up right now. I think silver is going to partake in it. I think silver is going to break a 45, 50-year cup and handle pattern. It could do just incredibly insane things to the upside over time. I'm not saying it's going to occur 1 month from now. I mean, we could be way up, but I don't think we're going to be in multi-hundreds in a month or something like that. So it's going to take some time. It's all going to participate. Platinum also looks incredibly good. It is the cheapest of the metals on a ratio perspective. And then palladium, I think, is bottoming too, on top of support that runs all the way back into the early 2000s.
Cool. Well,
So I think they all look good.
before we get into PGMs, which are
Mhm.
probably more exotic, I do have an interest in them as well. But let's go back to gold a little bit, Andy.
Mhm.
When we talk about gold going up and the reason why it's going up, do you then conclude that somebody coming into this market, maybe, they don't know where to start, and they don't really have any exposure to it? How do you play this? Do you get exposure to physical gold? Do you go for miners, and then within that, producers, developers? How low do you go in the chain?
Well, that's all up to the individual and what they want to do. I don't want to say that any individual should be in one sector or another of this market. The most direct way to play it with the least amount of risk is just go buy the physical metal. And that's where I put a large chunk of this guy's money, the physical metal, get it kind of out of the system. And that's actually a huge chunk of my net worth is in the physical metals. Now I'm probably labeled as a nut, right? So big physical metal holding, that's what I prefer. I think the miners could do very well as well, but you're taking on a lot more risk, and that is what you have to balance. How much risk do you want to take, and what is the potential rewards with that risk that you're taking? Is the rewards that much more than the physical price movement of the metal itself? So you have to balance the difference of that reward versus the difference of risk that you're taking. With the physical metals, I consider that to be the safest investment of any investment in the investment space. It is safer than bonds. It is safer than cash. It is safer than literally anything. So that is what I see as a savings vehicle. So I save in what is cheap and a precious metal. With with what I think is a very big upside with where we're located with the cycles. So yes, I save my money in physical metals, gold, silver, whatever it is, and I speculate in the miners. Now, speculation and all that risk could pay off very big with where the gold and silver mining companies are in relationship to the physical metal itself. So if I was just starting out, I would get physical metals first, build that base with low risk, anchor my portfolio with low risk, is what I like to call it. And then if you want to speculate, I kind of just go like all the way out to the junior land, and kind of skip over the big boys. The big boys, I think, are going to have to replace a lot of their reserves. I don't think they're going to grow production. So I avoid those, and I go straight to smaller companies like the small cap, mid cap companies if they're producers, and then I go into the juniors. Those are just lottery tickets, and with where we're located chart wise, with gold breaking to the upside, with silver basically clearing its downtrend line, and the bigger pattern that could be activated on the 50-year, I think having some money in the juniors is worth it. It's worth the risk, because if we do engage that, I'd like to have some exposure to something like a junior silver company or small producer. And most of these producers are pretty small. Even the big producers are still not that big. So even the bigger silver producers would, I think, be worth it. A lot of the silver comes from like copper mining and some of the big diversified mining companies, just so you guys know. And you could even play it through that as well, because you could play copper and silver kind of put together in some of those big diversified mining companies and still, I think, be a better bet than some of the large companies.
Interesting.
But some of those are sold off to royalty companies and stuff like that. So You might
Mhm.
want to look at the royalty company versus the copper company itself.
Yeah, if
So
gold
that's how I
goes
would
in,
play
if gold goes anywhere where we think
it.
it might, I think the royalty companies are going to be embarrassingly hot. Like it's gonna come to a point where like people won't be able to do the math quick enough to understand what they should be worth on just on any chart. So speaking of charts, what kind of charts are you looking at right now that you just find super intriguing? I know you're a chart guy, and you're obviously watching, I don't know if you do ratios, gold silver ratio, or if you're looking at each individual company and going off that. What really has your eye right now?
Is this open to everything or just
To everything.
everything? Okay. Silver right now is one of my top things that I'm looking at, and so is platinum. Those two metals with again with that alignment of the yield curve, the alignment of the larger overlay of the credit cycle, and with gold breaking to the upside, and the likelihood of silver following gold, the likelihood of platinum also following. I think those two metals, they're going to do crazy stuff here. Like they're going to do some crazy stuff. Hopefully sooner than later. I know a lot of people get pretty impatient, but the setup is there, and I think we could see a really big run. I mean, big run in both those metals over the next, I would say, year, 2 years, 3 years, 4 years, something like that. And we'll have to see what occurs after that. I think oil looks good. If you want something that's moving right now, oil is coming into seasonality. We're starting to break some resistance lines to the upside. I think oil looks pretty interesting. I've already been positioned in it for a little while, even before this. So I'm not buying much in terms of oil exactly where it's at. It's kind of in motion. And natural gas, with where that's located and what's coming online in the future, I think natural gas is probably the cheapest commodity in out of everything.
What's the fundamental thesis behind natural gas? I know nothing about it.
Yeah, so natural gas is taking over a lot of coal power plants. So they're taking coal power plants, replacing them with natural gas power plants. Natural gas power plants is the swing producer for electricity. So if they're not generating electricity from any sort of renewable, whether it's solar or wind, nat gas covers that demand. So from a supply aspect, we also have a gigantic wall of liquefied natural gas terminals coming online starting late 2024 and onward. I'm talking a massive wall of takeaway capacity. We've got this little inventory that everyone stares at, where the days of coverage of this little inventory continues to go down as demand rapidly moves up. So we could be at 50% inventory level or greater at these levels. Kind of, I'll say we draw down from winter, we draw down into the spring, and then we refill it back up. The inventory. The inventory is like our buffer, basically. It buffers in the winter. It buffers when we need to yank more than what we are producing. But that inventory is not really growing. It's really small in relationship to the demand and how much that's growing I would say, over the past decade. So I think that the volatility of natural gas is going to go up as the price sensitivity to the inventory level storage, I think, will increase with time as demand goes up and the days of coverage go down. So right now we've had two warm winters in a row. We haven't drawn down that inventory very much, but we've got this wall of takeaway capacity coming in 2024, 2025. And I'm like, how are we going to produce all this natural gas for this big, large amount of takeaway capacity that is coming? And what does that transition look like? Right now, you can buy natural gas at what I think was probably the cheapest it's ever been in relationship to other assets. So that the uranium to natural gas ratio, natural gas is off the page cheap because uranium's up and natural gas is a dollar, whatever it is, $1.78, $1.80. And we've got a cheap natural gas to oil ratio. I mean, it's cheap against absolutely everything. So the question is, what's going to be the catalyst to basically kick this thing all off? Well, I think if you buy it, somewhere in this next 6 months or something like that, that takeaway capacity comes online. If we have one cold winter, we're going to moon this thing. Like, it's going to move because people are going to see how little inventory we have, days of coverage. It's going to yank down that inventory way down. And if Europe has a cold winter and we have a cold winter all at the same time, that takeaway capacity is going to start to be used. And as we continue to increase power burn, electricity burn from natural gas, with natural gas power plants replacing coal, I mean, all of this kind of adds up where we get this gigantic demand for natural gas that wasn't there 5 years ago. Another thing that is coming on the demand side is artificial intelligence, which just sucks down electricity like no other. We also are trying to dump more and more electric vehicles and all these things onto the grid, whether it be electric motorcycles, mopeds, electric, whatever it is. So if everything is going electric, if AI is coming on with these data centers that are just sucking through all this electricity, and we are moving larger and larger percentages, I think the electrical power generation of the total, 45% of that comes from natural gas now. 45%. Uranium's
Wow,
only 10% in the
that's
United
a lot.
States.
Hmm.
And if we get one cold winter, and all of this is subjected to winter, or to weather, I mean, everything is subjected to weather. So natural gas is covering the weather shortfalls of solar, the wind shortfalls of the wind, for temperature, temperature for heating homes. I'm like, man, this could get really interesting because we can't control the weather, human beings. So if we have this small days of coverage, we can buy this at a really cheap price and just sit in it and wait. And all you need is one cold winter. And I think we could go from $1.50, $1.75, $1.80 from where we are today. We could go over $10 a million cubic foot like this because that inventory is not very big. And as long as the demand keeps going up from all these different sources, I see it as a really good long-term play. And to be honest, I don't even know if we've got that much natural gas in America to feed all of this all in one shot. Like, I mean, we're putting on a lot of capacity, takeaway capacity. We're putting a lot of electrical demand on. We better hope we can produce it and hold that production for a decade plus.
Holding the production
So,
for a decade plus is the big thing, I
mhm.
guess, right? Whenever you stretch things out to just a little bit longer, than 3 to 5 years, then you see all hell break loose. Same, I guess, with uranium. But before we talk about uranium, you mentioned PGMs and how they're super cheap right now. How do you figure?
Yeah, so platinum group metals, again, I use an asset versus an asset, compare it all to history. And when you compare it to history, platinum is the cheapest in a ratio perspective against silver, gold, palladium, and rhodium. It is the cheapest by a long shot. The catalyst that kind of kicked this whole thing off was the Volkswagen Dieselgate scandal. There's a lot of diesel engines that were yanked back, and platinum demand went down. But platinum's been in a deficit the past year, a 1 million ounce deficit. And from production only produces about 6 million ounces a year. So we were a 1 million ounces deficit on a 6 million production. There's about just over 8 million in total recycling demand or recycling supply plus the production. So with that setup, in that location there, just how cheap it is, the question would be, what is the catalyst to get it to move? And then some history on it. Platinum does very well under inflationary conditions. It is shown to outperform silver and gold under inflationary conditions. In the Weimar hyperinflation, it was priced at 5.5 times the price of gold in Weimar, Germany. So if we get into a very inflationary period, which I think is a high likelihood, and with the demonstrated performance that platinum has had historically, and with where the ratio is located today, I think that's got the highest upside potential of any of the metals when looking at it from that perspective. I also think silver's got some pretty good upside potential too. So I look at that and I just say, I have to be here. Given the demonstrated success under inflationary environments, with what I think is coming, which is going to be an inflationary environment, and with where the ratio and how cheap this metal is, platinum, uh, with respect to everything else. I mean, this is really, really cheap. It's not, this hasn't been this cheap ever. If I'm going to try to say, so the gold to platinum, the platinum to gold ratio is 0.4. It's never been 0.4 for any length of time. Only in 2020 where it dipped back down. Looking at like the 1970s, platinum was priced like 3 times the price of gold in some of these areas. So when you look at this and you're saying, well, okay, we got 3 times, 2.5, 3 times, we've got 5.5 times back in Weimar, Germany. I mean, if we go 2, 3 times gold, and I think gold's going a lot higher, platinum's just going to do some ridiculous revaluation. And the way that I view this, like, think of it, this is the way that I think of it. How many ounces of gold can I accumulate, and what can I buy that may accumulate even more ounces of gold? So if I buy a cheap ratio of platinum at 0.4, make it 0.5 to make the math easy, and we were to go 3 times the price of gold, I get 6 times more gold. So I get a 6x on that move. And that, I mean, if you think about it, and let's say we do that with gold going up. So let's say gold goes from 2275, 2280 of where we are today, and we go to something like 5 grand or 8 grand or 10 grand or whatever it is. I mean, think of 6 times from today what that price is out in the future. So it is a huge currency revaluation of purchasing power is what I'll call it.
That becomes unimaginable, I guess, at this point. But then again, whenever we did reach the highs of like the 1980s and the 2011 high as well, those numbers were also unimaginable back then, and that's how bull markets work. With platinum, the fact that 70+% of it comes from South Africa, how do you play it? Do you go into South Africa into the miners, or does that kind of defeat the purpose? Because if there's disruption there with their grids failing and everything else, they may actually not get the benefit of a possible bull market. Do you buy physical platinum, or how do you play it?
The physical metal is by far the least risk way to do it, and that risk being that low, I think makes it very attractive, and with the upside potential reward. So I look at everything as a risk reward basis. So if the rewards are that big and you are carrying very little risk, then yeah, it makes sense to buy a bunch of physical. But I would also buy the South African miners too. The reason I would do that is because they're literally a monopoly, and they are the largest monopoly in the world of any commodity that in existence. They control and produce the largest percent of any commodity in the world. So if Russia has a problem, which very well could, they're like the other 30%. Let's say they're about 30%, and I would say South Africa is about 60 something percent, 70%, depending on the metal that you're talking about. If Russia does something, then I mean, you basically just won, because if something occurs in platinum or palladium or rhodium or whatever it is, and these things move, you're going to capture that. Like that's like a one-stop shop. That's the only spot that they can really get any sort of metal from, and they will be the underlying. They will catch that move. So I think it's a really good. I think it's a really good bet. Then it comes down to how do you position size, right? How much risk are you willing to take?
Yeah,
So
absolutely.
I like the physical. a lot less risk. If you take the miners, which have all the leverage, well, now your risk is going way up. Because if something does occur, then that's what you could potentially risk or lose.
I love how you have
So
the moon in the background. It's so fitting to everything that we're
it is.
talking about. Speaking of mooning,
Mhm.
oil, is it too late?
No, it's not too late. And it depends on how you want to play it. There's not one way to play this. You don't have to play a oil, gas exploration production company. You've got energy service companies that a lot, I mean, there's a lot of opportunity there that are still cheap. They're still squeezing up the services and the day rates and all that stuff are getting squeezed to the upside. Um, Oil and gas, the way that I view oil and gas, it's like that's where the rich people hang out. Like that's where you want to be. And then like all these other sectors, it's kind of like, this is like elementary school. It's like because like these guys are buying back shares, they're giving big dividends, their stock
They're
prices are just
actually
ripping
cash
to the
flowing, which
upside.
is something that mining
Yeah.
investors cannot fathom.
Well, it's like you're in the big old club here, and they're just like sitting there stacking hundreds. It's like this day we made all these hundreds. And then they're like, we'll buy back a bunch of shares, and the stock price just keeps going up and up and up and up. And everyone else is like, well, maybe I'll try to buy this small mining company. I'm like, you're getting diluted to death, but you don't want to buy this company that's inflecting into earnings. Like they're just inflecting into earnings. And their management team is like, we're going to buy back, when we get to this certain debt level, we are going to buy back 100% of our free cash flow. We're going to buy back our shares and shrink the share count. And I'm like, I'm in. You convinced me without me even really thinking. So I look at these other, sectors, and I'm like, man, they're really struggling. Like they are struggling. They're not making a lot of money. Their valuations are not that great. I mean, they're okay depending on where you're looking. And then I go over to oil and gas. I'm like, you can buy this. They're going to buy back all their shares, and you're paying like 2 times cash flow. I'm like, that's stupid. This is like cheating, guys. It's like, here, pick up free money. You want free money? And everyone's like, no, I don't want free money. I want to make this the hard way. It's like, no, just I don't know. That's my take. It's like take the money when it's there, and if the valuations are cheap and they're going to do all this stuff and they're going to be shareholder friendly, just take it. That's my take.
Speaking of struggling companies and mining companies in general, what are your thoughts on uranium, the actual commodity versus the miners?
Well, so the commodity looks really good. I think we're going to go higher. I think we're going to go higher than 100. Give it time. They're going to have to turn on all these mining companies. The issue I have with the companies themselves, though, and I think they will go up, and there's going to be money that flows in here. It's going to be like previous bull markets. They're going to go way up, but actually making the mine, there's a lot of risk. You've got interest rates doing this, and money's becoming more expensive. It's going to be more scarce and harder to get. And then you've got these companies where they're not cash flowing, they don't have any infrastructure in place. And I don't know if they're going to get into production for quite a long time. So I think there's probably some near-term producers, and near term's probably 2027. And that's about it. 2026, 2027, there's a handful, that's about it. And then outside of that handful, it's like, how are you going to make money? Like, how are you going to make money? How are you going to add value for the shareholder? And how are they going to pay you as a shareholder? Now, the one thing that drew me to uranium is they have very good, the companies have very good probabilities of following the uranium bull market. It seems like they all follow it pretty well. So the demonstrated success in history is high for companies that don't make any cash flow. So that's the reason I'm there, because of that probability and how well they correlated with the price move of uranium before. And I hope that correlation stays and we get these big moves out of these junior companies and some of the developers that we all like. So the companies themselves, they're not like, they're just not as mature as other sectors. And that makes it a little more difficult to just pile a ton of money into. Like I can't put I'm not going to put 50% of my portfolio in it. It's just that'd be too large of an allocation. So, but again, the correlation, money flows coming in, I do think that they'll probably have a pretty big bull market in uranium. And that's what
And
keeps me there.
that's a very good point that I think most people don't realize, that a uranium bull market is essentially a speculative bull market, just as you said. It's just a reflection of the commodity itself. It doesn't mean that the individual companies are, making such outsized gains that their move is justified. I remember this because I was trying to research the past bull market, the one that ended, I think, in '07. And everybody talks about that old story of Paladin going from 10 cents to 1 cent to $10. It's the old Rick Rule story. And you look at the chart and you zoom out and it's absolutely magnificent, right? It's like, wow, I wish I would have gotten into this instead of like being in high school. However, most people forget that the same happened to Laramide. Laramide never went into production. They still exist. They're still, a uranium company in the USA. And the same thing happened to them. So it's a mixture of how well promoted the company is, what stage of development they are for sure, but also, the sometimes something as simple as the share count and who's buying it and who's not selling it. That can really make a massive squeeze. So that's a very good point. And to go
Can
ahead.
I make a comment on that?
Sure.
Yeah, so that company went from Explorer, went through the entire Lassonde curve all the way to the beginning stage of a producer. That's like the max value that you can literally make in a commodity bull market if you can go all the way through that. Another thing is in uranium companies, since they don't have cash flow, they can't really change their future outcome as easily as, say, an oil company that's got a bunch of cash. So if an oil company has a bunch of cash, they can manipulate the stock price themselves if they want to. They'll say, we're going to go buy back our stock. And that is demand for their stock. So what you'll see is you'll see the price of the shares go up. And then if they start buying back shares, and let's say we get a pullback, the pullback might just go sideways as they buy back a bunch of shares, shrink the share count. They are the demand for their own stock, and then they take off again. So you don't really get these big pullbacks. They're not as violent, or they may not even pull back. If they buy enough shares, they'll just keep going up. And a success story, if you guys really want to see about share buybacks, look at AutoZone. AutoZone, which is a company that does automotive repair and sells stuff. They did a huge share buyback basically the entire time. And look at their chart, it's like straight up. And what's
Wow.
occurring in the oil markets right now is that exact same setup as AutoZone. They are literally going to point hundreds of millions or billions of dollars, depending on the size of the market cap, right back at their shares. Like they're going to aim at it and be monster, I'll call it monster buyers of their own stock. A lot of these companies are talking about, once they hit certain debt levels, which a lot of them are hitting now, they're going to start buying back 20, 30% of their stock. Some of them are buying back 100% of their free cash flow. And their free cash flow moves monster. It moves huge compared to the price of oil. So if we have in some of these high cost producers, if we have oil at 75, they're like, they're profitable, but not very profitable. But at $100 a barrel, they are raking in billions. Like it is a big difference. And if they're going to point that billion back at the share count and reduce the shares, they're gonna really push their earnings per share up. They're gonna push your production per share, free cash flow per share, and that's really what you guys should worry about. All of those metrics are going to go like this for you, and that's why I'm so bullish on oil. And keep in mind, oil is also a very inflation sensitive commodity, and it's like man, this is a really good setup because I think inflation's coming from the debt, that big debt cycle that I talked about earlier. And these guys are literally going to benefit from it and then turn around and give all the money back to you. So I just think it's a really
That
good setup.
seems like a very good proposition and kind of the opposite of what we do in the mining world, which is like we need to dilute in order just to exist. And in
Yes.
the oil world, it's quite the opposite. You know, they're literally throwing cash to bid you up, you know, to get your bags be worth more. That sounds good.
Yeah, and you don't have to pay a lot to do it. That's what makes it so enticing. If you're paying 2 times cash flow and you think the cash flow is going to go up 5x, and you're paying 2x of it, and then they're going to buy back shares to shrink that down, it's like,
Right.
okay, I could be sitting on 10 or 20 baggers with the lowest risk, very low risk on these higher cost producers that really don't have any risk because their debt's all gone. They paid down their debt in 2020, 2021, 2022. So to me, it just, when I look at risk reward, I'm going, this doesn't make sense, guys.
You can't
It
ignore
doesn't make
it. You
sense.
can't ignore it for sure. So
Yep.
I guess my last question is how do you then watch for overproduction? Because that's probably a concern that we have in oil since the time to production is much quicker than we have, for example, compared to uranium. At which point do you look at your dashboard of indicators and say, you know what, we're producing too much, price is going to go down, supply has kind of, done its thing.
Well, so I take a stance here where I could be premature, but I don't think we're going to get much growth out of shale in the United States, and that's where the majority of growth came from. If we don't grow shale in North America, I think the Saudis are basically done. I don't think they can grow their production either. And I think that the world's going to struggle to grow production from 2024 onward. So with that, with saying that, I also think that credit expansion will continue to grow. Credit from, deficit spending, all of that stuff. So what I think is going to occur and what I think has already occurred is that the market is figuring this out and they are literally selling bonds to get away from bonds because bonds and stocks are all priced on future cash flows. And future cash flows are more or less a conversion of energy into cash. So you're converting energy into cash, whether it be a product where you take electricity through machinery or you take diesel to mine something out of the ground. All of these things are just derivatives of energy. And that's why energy is the number one commodity, and that's why it's very inflation sensitive. If credit continues to go up, 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 where they have to grow credit, whether it's interest expense or something like that, or they do deficit spending or a combination of those two things, your credit starts to grow, but your supply of oil can't. It gets stuck. That is going to be very inflationary. All of the charts that I look at are suggesting something like this to occur. The 50-year chart in silver that's ready to break to the upside, the 14-year cup and handle that's breaking on gold to the upside. The so if shale has, if we are close to peaking here in the next, this year, last year, I think we already probably peaked in oil production. That's the whole setup there. And the benefactors, in my opinion, of that in the next 5 years, oil is going to do very well. Natural gas will do very well because they're going to try to shift all this to electricity. And I don't think uranium can move fast enough. And then you've got gold and silver, I think, are going to do, and just any precious metal will do very well because people are going to start to worry about the bond market. They're going to start to worry about currencies. And the first thing that you're going to see break, which is already breaking, is you're going to see gold go up at the same time that interest rates go up. And then you're going to say, okay, the market's not trusting the bond market. They're moving
Something broke.
money. Yep, they're moving money into precious metals. And that's where the way that I view it, and again, people can disagree, and I'm fine that. I think that energy is going to be short. I think we're going to hit some of these constraints in other commodities like copper, nickel. We're not going to be able to easily move into this renewable world. And the constraint of energy growth is going to cause problems with inflation. And that inflation, credit expansion, and the way that the system is designed, where you have to continually inflate it, is going to run into an energy constraint, just like 1970s and just like the early 2000s before we hit shale oil. And that manifests itself in higher energy prices and also in higher metal prices, the precious metals. By far the least risk way to play that would be physical metals, because you just take it all away. Now, if this does occur, you have to look out, 5-10 years, what's going to occur with the oil market and the metals market and stuff like that. These countries are going to start to get greedy. They're going to try to tax them to death because they're going to make all this money. They're going to try to nationalize, use these companies as piggy banks. They're going to do all sorts of stuff. So the physical metals, you don't have any of those problems. Doesn't mean that I wouldn't invest in the companies, but they don't have those problems. That's all I'll say.
Yeah, proportionally, you gotta, like you said, you gotta assess your risk and know how much to put towards, different stuff. That is so good. It gets me thinking about my own portfolio and how I'm exposed to certain risks. Yeah, this is always love talking to people who are kind of on the same page but doing it in a slightly different manner.
So this is the question I ask about my portfolio, and I don't have the answers here, guys. These are just the questions I'm asking. In an energy constrained world, who makes the money? That's the question that I ask. Who makes all the money? If we get constrained in oil, who makes it? So you could have a $200 uranium price, but the uranium mining companies don't make any more money because their margins are constrained by the cost of the fuel inputs.
Yeah, and everything
some
else.
Of these other mining companies. So I would still have exposure to it, but I just keep asking the question, who's going to make the money? Maybe royalty companies make the most money. Maybe something else where they don't have the inflation input cost sensitivity as other companies. And that's the questions I always ask. And what I'm most afraid of is what's the input cost going to be like for this company if energy prices go up and stay sustained at a level that is much higher than what we are normally used to. And then if I start talking about oil prices, I mean, what if we see a sustained $200 a barrel oil price and a lot of people have to get priced out? Like, what does that look like? Who makes the money? Obviously, we're going to be doing energy service like mad. We're going to be drilling all over the place trying to find more, but that may not solve the problem if we just don't have the reserves. So I'm not trying to be like dire, like this stuff's gonna.
I'm starting to imagine like Mad Max.
But I mean, think about this in a longer term time frame. And that's what I'm doing. It's like, think 10 years out. Do you think that we've got enough oil to grow oil production for 10 years and we're in the middle of an S curve of India and China? I'm like, I don't know.
Yeah, I was going to bring up India because I think that the hunger for energy there, unless something bizarre happens, it's going to be just absolutely insane. Going from bicycles to motorbikes does it on its own.
And another thing, we've been riding. So in mining and in oil and any commodity, we basically bounce from demand destruction and back to the cost curve, and then we go a little bit below the high cost producers, and then we kick back up as the high cost producers come to higher costs. The low end that we bounce keeps coming on up as the cost of production increases. Now we've got technological advancements that try to bring that cost curve down, but really it's technology versus your declining ore grades or declining reserves that are tougher to get. So you've got these two competing forces. The overwhelming factor that I see is that the decline in ore grades overpowers technology over time. And when you get to certain levels, which we're already at, the energy input goes up exponentially. So I keep thinking like, who's going to make the money in this system? One easy way to think about it for me is, well, if I just buy the commodity, the physical commodity in a low cost energy environment, and we go to a higher cost energy environment, that means the cost curves will go up. So that's one way I can protect myself against inflation or higher energy costs, is just buy the physical commodity, hold on to it for a while, then sell it in a higher, more difficult environment to extract it out of. But I am taking some risk because you've got artificial intelligence coming, or maybe there's something they can do there, and I don't know. Maybe it can figure out fusion, or maybe it can do something that I can't think of. And I don't think they. I don't know. My idea of AI is just a big database that it kind of draws from.
Mhm.
I don't think it can think for itself yet. So I don't know how advanced AI
I
is
think
yet.
we're dangerously close to it thinking for itself. And the other
Mhm.
thing is that in my mind, whatever technology we have now is old news, right? I think they're kind of sandbagging everything. And I don't think they want to freak people out, especially because I think governments will want to like legislate and regulate the hell out of this. And I think they're kind of like trickling out, okay, this is the next version, when actually it was probably the version they had, I don't know, 6, 9 months ago or something like that. So who knows how advanced we really are, but we'll soon see. Andy, thank you so much. This has been a great conversation into just a little bit of everything that I really love to talk about, think about, and be challenged about. My viewers would love to follow you and get to know you a little bit better, and maybe even sign up for your services. How can they do that?
Yeah, you can follow me on YouTube, Finding Value Finance. It's right there. And then uh, at finding_finance on Twitter. And if you want to check out the website that I've got, we have a community that we built up. It's finding-value.com. It is a pay for membership. And that is where I dive really deep into a lot of the stuff that we were talking about: individual companies, individual sectors. How do I pick this stuff? The technical analysis I use, the fundamental analysis. I don't know. I consider myself a hybrid, so I use fundamentals and technicals. It's the way that I have found to get the highest rate of success, and then I take a long-term viewpoint on it. So I'm basically adopting Warren Buffett and Peter Lynch's approach and using ratios to identify the value, and then I sit in it for a long period of time
Awesome.
for that to mature.
To pan out. Thank you so much, Andy. Let's do this more often. Speak to you soon.
Yeah. See ya.
Cheers.